Good afternoon, Quasar Markets Live. Howard Greenberg here with the president of the Blue Collar Investing Corporation, Dr. Alan Ellman. Doctor, how are we doing today?
Every day's a good day here in Southern Florida.
Well, that's good to hear. That's always good to hear. Um, we your last interview with us last week went over really well. Was very excited with some responses we got, and you are already coming back on to talk and about some questions that came up during last week's show, which was how does your covered call, theory and form of methodology, I should say, more than theory get affected by earnings reports and the fact that we're in the middle of earnings season. So you put this together for us. So I don't want to take away from you. Why don't you tell me a little bit of what you've put together for us?
Well, in the BCI methodology over the last 30 years or so, I have a whole litany of rules and guidelines as to how to handle this particular strategy. But I do have one rule, okay, and that is to avoid earnings reports.
Right.
And the rationale behind that is we're taking a strategy, covered call writing, and we could say the same for selling cash secured puts, are low risk option selling strategies. They are for investors who have a relatively low risk personal tolerance. Now, if you integrate earnings reports and the risk involved in those into the strategy, now all of a sudden you're changing a low risk into a high risk strategy.
Yep.
So the one rule in the BCI methodology is to always avoid earnings reports. Now, I have various rules and guidelines how to do that, but during earnings season, as you alluded to before, many stocks, ETFs do report. So how do we circumnavigate that issue with so many reporting at the same time, and yet we still need to fill our option selling portfolios? And that is the essence of this presentation.
Great.
Now, you see in this particular slide here, I'm just defining for your viewers who are not familiar with the strategy of covered call writing. So it's basically it's three steps. The first step is to buy, or perhaps you already own a stock or an exchange traded fund in 100 share increments, because for every one contract we sell, in order to be covered or protected, we must first own 100 shares of that underlying security. So that's the term covered in
Yep.
covered call writing.
And I do want to just hit on that again for the viewers. Again, you don't have to start this position because, from scratch. If you already have 100 shares of a position and you're just getting into this, you are able to use those already. So I just want to make sure they understand that.
That is correct. And actually, for those of your viewers who want to use their own shares and do it with covered call writing, there's a very specific way of doing that because perhaps they've owned these shares for a long period of time at a low cost basis, generating dividends and in non-sheltered accounts. So if that option is exercised and the shares are in fact sold as a result of exercise, there could be some negative capital gains issues they have to
Sure.
deal with. So there's a
Definitely.
very specific way of dealing with covered call writing in the scenario that you're alluding to, where they already own the shares. But for traditional covered call writing, the way I do it most of the time, it's a little bit different because I could care less if my shares are called away.
Right.
As a matter of fact, it's a bonus because I get the money back sooner and I could reinvest it in the same contract cycle and start a second income stream.
Yep.
But the second word in covered call writing is the type of option we're selling, which is a call option. So in essence, we are selling some unknown person the right, but not the obligation, to purchase our shares from us at a price that we determine, that's known as the strike price, by a date that we determine, that's known as the expiration date. Now, most options expire on Fridays at 4 p.m. Eastern Time. Now, the third word in the term covered call writing means that we are initiating or starting a sell to open order. So when you go on your broker platform and you put in options, what do you want to do? I want to sell to open this covered call trade.
Right.
And the third step, buy the stock, sell the option. And then, of course, you go into position management mode to manage your trades if necessary. And then, of course, we get paid very handsomely in the form of an option premium once we enter a trade.
Absolutely.
Okay, so the next slide is what is earnings season? Well, that's the period when most publicly traded companies produce these quarterly earnings reports. And like you said, Howard, we're in the midst of it right now. And this particular week, we have a lot of the large cap tech companies reporting, and that could create some volatility in the market,
Yeah.
depending on whether there are beats or misses or whatever. And that's what I was talking about before, the volatility and risk created with an earnings report. And typically it starts 2 weeks after the end of a quarter. So you see the 4 months I put down on the slide of January, April, July, and here we are in October. And typically it'll last about 6 weeks. You'll see kind of NVIDIA closing things out for the large tech companies 3 weeks into November. And the analysts that follow these various companies, they have consensus estimates regarding sales and earnings. And the consensus is kind of you add them all up and you're averaging them together, and they'll say something like, "We expect our earnings to be $1.25 a share or whatever." And then if it actually reports lower than that, well, that's a miss, and
Right.
it could cause the price to go down substantially, and vice versa for a beat, then it can go up. So therein lies the volatility
Right.
of earnings days.
Yeah, I mean, Tesla just went up 20% on their earnings report the other day. And in the
Right.
same thing, we saw ASML get hit for, almost that same to the downside.
And last week, Netflix.
Yep. Yeah,
So, yeah.
earnings have definitely been explosive lately. So it would make sense. And I love the way you put this together because it sounds, I think, and when you first said it to me, it sounded more difficult than once I start to see your slides and the methodology. And what you realize is that, you know, when earnings are coming. So it's not like you're getting you had to wait to today to get prepared for Ford's earnings tonight. You've been
You
putting
hit the
this into
nail on the head,
place.
Howard. We know the date.
Right.
And if we know the date, we can easily avoid it. Now, I have seen many presentations where they actually encourage investors to invest through earnings. And the rationale behind that is because of the higher implied volatility in that underlying security, the option premiums will be much greater.
Right.
And so it's enticing to sell an option when the premiums are much greater. However, you also have to factor in the risk to the downside. So
Sure.
there's actually two sides, two reasons why you shouldn't be doing this. If you already own a stock and you want to keep that stock, I'm not telling you get rid of it until after earnings. No, I'm not saying that. What I am saying is if you own the stock, like portfolio overwriting, and you want to write covered calls on it, just skip the week of
Right.
the earnings.
Yeah,
And
it's
here's
not
why.
you're not saying that you have to miss that entire 6 week session. What you're saying is that last 6 weeks usually earnings every 4 times a year. But as long as you avoid that 1 week when you're writing it, that then you're taking care of yourself. You're protecting yourself from getting that volatility play the same week that you have expiration, where it would be more likely that your shares might be assigned or taken away.
Well, exactly. And, so people will sometimes say, well, if you write the covered call and there's a miss, at least you got the premium from the covered call. I understand that rationale. However, the statistics over the last 5 to 10 years are that there are about 70% beats to 30% misses. So if you write a covered call on a stock you already own, right? And it goes through an earnings report. You put the call in, you're going to lose all that appreciation as a result of that share value increasing as a result of the beat,
Right.
right? So you're in the 70% category if you don't, because then you'll be able to take advantage of that appreciation. And then when the report passes, you double down and then you write the call and generate even more premium, even though it'll be lower than it would have been before the report, but you're still getting another income stream.
Absolutely. And it's already given you its bias.
Right. So if you do not write the call, that will benefit you. I haven't done a deep study on this, but I'm giving you a general idea. that will give you about a 70% advantage probability of throwing it in your favor. Whereas if you do write the call for a miss, figuring what if it misses, then you're in that 30% category.
Right.
So, it's
It's
rhetorical,
funny
which
how
is
analysts
yeah.
still get paid. I wish I only had to be right 30% of the time.
Yeah. So now, okay. So I just want to show you in these last couple of slides what we provide to our members. And even if you're not a member of BCI, whatever screening process you use, you should factor in the earnings report dates. Now you'll see those, Howard. It's the fourth column from the right.
Yep.
Some of them are in red bold. When you see red bold, that means the earnings dates were actually confirmed by the company. So we provide those dates to our members. So if you're a member, you get the watch list, you don't have to screen. If you're not a member and you have your own screening process, be sure to incorporate earnings dates into the report.
Sure.
Now you can see what we have here, that thick black line will um, separates the securities that report the first week of a monthly contract or that particular week. So when that week passes, they become eligible. So
Right.
it doesn't mean you have to miss a whole month. They become eligible.
Sure.
And then the securities in the white cells, where you see the broken red arrow, those are securities that don't report in the October contract month, which is the one that were the November contract month
Contracts,
that
right.
we're in now. So yeah, those are eligible for the November contract. And then once the week of the report passes, then you can boom go right back in and write weeklies if they have them, or go back to monthlies after that. So there are securities. I mean, it's a little more challenging to fill up a robust portfolio, but it's doable.
Absolutely. Absolutely. I mean, there's, yeah. Your watch list or, has a big enough, abundance of options of choices, I should say, of stocks to look at all times that there's always ones in play. So that's what's important. And we've also talked about sometimes no trade is the trade. So, it's taking a step back during earnings and making sure if you normally carry X amount, let's say you normally carry 10 trades, if on any given week you're down to 8, that's not necessarily a bad thing. It gives you a little bit of ammunition to reload and get back in, and it also allows for you to pick just the winners.
Yeah, that's a good point. But I've found over the 30 years of trading covered calls that almost all the time I could fill up a portfolio.
Yeah.
Um, and the next slide, I'll address this slide in a moment, but in the next slide I'll show you what makes it really easy. But this particular slide, where you see the red arrows, indicates which of the securities that have passed the rigorous screening process, which is on the blue bar at the top, uh, are eligible, and then the ones that have weekly options affiliated with them. So the week of the earnings date, skip it, and then you can come back and write weeklies after that.
Sure.
Now, the screening process on the blue bar, we don't have to go into detail on that, but I'll just say this. It involves fundamental analysis, sales and earnings growth. It involves technical analysis, identifying trend and momentum, and then common sense principles like minimum trading volume, diversification, cash allocation. So it's a pretty rigorous screening process. And then we have the list, and then we let you know when the earnings dates are coming, plus a lot of other information. And then you can avoid the risk of the earnings dates very easily by using our reports or creating one of your own that has that column in it.
Yep. And that's a huge advantage to your subscribers because I can tell you from someone who sets up screeners all the time and in doing things, trying to put together the combination that you have of both fundamental, also earnings, also technicals, all involved in a watch list, and looking at diversification into that, into different industries and everything there. That's a tremendous help to a lot of investors. So even before you get into the process of the covered calls, just getting this screener is huge for a lot of investors.
Yeah, and the fact that it creates a watch list. Typically, there's 40 to 60 stocks eligible, but during earnings season, you might only see 10 to 15. But
Right.
in the next slide, I'll show you something that'll make it easy. Here we go. Exchange traded funds, Howard, as you know, uh, do not have earnings reports.
Yeah,
And
absolutely.
so, in this particular screenshot here, this is a recent ETF report. We provide those to our members midweek, and the stock report comes out on the weekends. But at the top of the list, we have ETFs. They have to have a minimum trading volume of 250,000 shares per day on average,
Okay.
relative strength ratings of 60 or better, non-leveraged. I don't believe in using the leveraged securities with covered call writing. And if these are securities that have outperformed the S&P 500 in two time frames, both 1 month and 3 month time frames. So any ETF that has passed our screens, you don't have to worry about earnings reports
Right.
because they don't have them.
That's right.
And and in the middle section, that relates to maybe another time we could talk about the
Sectors.
CEO strategy that I created a blueprint for a streamlined approach for covered call writing. That sometimes members will say to me, "Hey, Alan, I'm raising three kids, I'm working two jobs, I like to golf on the weekends. Is there a way I could do this that's a little more time efficient?" Um, so I spent about 3 years trying to figure out this blueprint, and then in 2022, Howard, it clicked, and I figured this out. I call it the CEO strategy. It's combining exchange traded funds with stock options. We only look at the 11 select sector spider ETFs that break up the S&P 500 into 11 different sectors.
Right.
And what I did was for that entire year, I took a screenshot of every trade that I made using the rules and guidelines that's in my book of this strategy. And then at the end of the year, it shows how I beat the S&P by 15%.
Wow.
So it's a great way to dip your toes in the water if you're really busy, whatever it is, and you still want to generate cash flow. It will be lower returns than traditional the way I do it, but
Right.
that's that middle section of the report is for the CEO, and the bottom section there is our inverse ETFs. So those are securities that go up when certain market benchmarks go down.
Yeah.
2008, you could have made a ton of dough using
Yeah.
these
Oh yeah.
inverse ETFs, but you most of the time you don't use them.
Now might be an interesting time. Steve and many others calling for a 10 to 20% pullback here in the markets over the upcoming months. So we'll see what happens there. The problem that everybody has is that with earnings right now, you could see a 10 or 15% run up before you see that pullback.
Well, I'm not quite as I'm not in that category right now. I'm pretty bullish. Looking at the interest rate cuts that are coming up. As long as our economy keeps on improving, I'm feeling a little bit more bullish. But one of the great things, Howard, and I'm glad you brought this up about covered call writing, it's different than long-term buy and hold portfolios.
Yeah.
You're reevaluating your bullish or bearish assumptions every week or every month, depending on if you're doing weekly or monthly contracts. I never go out further than a month.
Yep.
There's several reasons why I don't, but I don't. So if I'm doing weeklies every week, I reevaluate.
Sure.
With that stock, with the overall market, am I going to take a bullish approach to covered call writing and go out of the money? Am I going to take a more defensive approach and go in the money where the intrinsic value component of the premium will give me more protection to the downside? And so that if the market starts turning down, it's not going to happen in one day. It'll happen over time,
Sure.
and you could craft your portfolios based on what's happening at that point in time.
Absolutely. You got to play the market in front of you. People that are if you're too perma bullish or too perma bearish, you tend to have problems. You want to make sure that you're playing the market in front of you. It's a rapidly moving market these days. Um, yeah, and it's going to be interesting to see what happens because as I was talking with Stephen Flanagan, who used to be with J.P. Morgan's FX division for 30 years. What we're talking about is the change in algorithmic trading has a lot to do with also the way cycles work now and the way bullish sentiment because there isn't necessarily sentiment involved in that they're using formulas. So if a stock goes up X amount, they recalculate, they recalibrate, and they have to analyze and reset and allocate their funds so that you tend to have a different play than what you used to see. So it's going to be interesting to see. because a lot of metrics show us as, severely overbought. You got a lot of people from the Bill Ackermans to Stanley Druckenmiller to Paul Tudor Jones, to Warren Buffett, who are holding huge amounts of cash on the sideline. What we've been talking about on our shows too is that what you got to realize, you got to poke your head up above those clouds and take a little bit of a bigger picture and say, well, if you're a European hedge fund, where are you putting your money right now? Are you putting it in Europe where they have anemic growth at best? Or are you maybe putting your money in US dollar and then therefore US equities, and that's going to continue to prop up this market, whereas maybe some of these folks aren't seeing that. So it is going to be interesting to see how that goes. I am going to try to get a roundtable and then after the election, of a lot of our contributors, because everybody has a different view, and we want to see after the election, I think, how everybody's sort of macro view looks going into the end of the year and into the beginning of next year. So we'll definitely get you in on that panel for sure.
Sounds good. And very well stated, by the way. Appreciate that. And for
Okay, now we're looking at your blue chip Dow 30 report.
yeah, blue chip is really, the Dow 30 report. Some of our members only want to deal with these blue chip type companies. So as a response to that, we created this monthly report. The stock report and the ETF report come out every week. This comes out the week of monthly contract expiration for the following monthly contract. And what we do is we chart the Dow 30 stocks, and in order to be eligible for this report, they have to have outperformed the S&P in both 1 and 3 month timeframes.
Okay.
And then we give additional data, and the red arrow shows what we're talking about now is the earnings report. And these have weekly options associated with them. So you can also turn to the blue chip report for additional securities that will allow you to beat earnings. And you can add that to the entire ETF report. And then you can add that to the stock report, the securities in the white cells, and then the ones after they weekly passes, then you can jump on board with those. So the point here, Howard, is that, there's not always a great solution to funding large portfolios during earnings season, but there's always a best solution.
Absolutely.
As I said, in 30 years, Howard, very rarely have I had a difficult time funding my portfolios for
That's
coverage.
great to hear. My takeaway is that I keep coming out of this. We've only had this is our second interview, but I'm amazed at how much you have fine-tuned your methodologies for all the different levels of risk, time frame, almost everything that a different investor might be looking at for it. And like you said right here, is there are people, you're right. Like, my father is one of them. I only want to do it if it's a company I know, which Peter Lynch, hey, listen, one of the best investors of all time said, right? Invest in what you know. So that's how my dad always felt. And, I love that you have put that already into play within your methodology, and they don't have to break it out. In other words, a lot of different services will hand you a piece of paper. It's got 150 and it says, now you determine from here. You guys have really gone that extra step and said, okay, if you're only looking for the blue chips, if you're only looking for X, Y, or Z, if your risk level is a little bit, these are the things that you do to trade and still use your methodology. I think that's amazing.
Years ago, you're making me think back a little bit now, Howard. Years ago, before the blue collar investor became an actual company, I think I told you last time I was a dentist,
Yep.
and the way I used to do my screening was my wife and I would sit down at the kitchen table on Saturday morning, and we'd have two computers, and we would do the screening that you see here,
Yep.
and and it did take a lot of time. So producing these reports for our members saves them a huge amount of time, but it also gives them the opportunity to select securities that aligns with their personal risk tolerance. Also, let's face it, cash available.
Yeah.
I mean,
It's huge different on this page right here. Cisco $54 is a lot different to do a covered call with than it is at Caterpillar at $392.
exactly. And if you go back to the ETF report, there are a lot of ETFs that are lower priced as well. And so, for people that have limited cash available, they might
Yeah.
want to turn to the ETFs. You could see, I can't read it that well on this screen here, but
Yeah, but you're down,
uh,
right. You have them down in the 31 level, 26 level, 31 level, 17 for the
right.
MSCI. So they run the gamut, and again, all the way up to 138. And that makes sense too. And most of the, or not all of these ETFs for sure, are going to have great volume in the options, which is going to lead into what our future discussions will be when it gets into spread on options that you have to worry about sometimes, and
Well, all of the
premiums.
yeah, all of the ETFs that make our report have at least 100 contracts of open interest and or a bid-ask spread of 30 cents or less. So liquidity is factored in to the report.
That's what I mean. You guys really, it makes sense after 30 years that you guys have gotten to this point. But I'm so impressed because I haven't dealt with any other service, and I worked for not a competitor of yours, a different style of service, as you know, with Prosper, and they didn't have it built down and drilled down this level. These were things that our educators would do on a, like you're saying, on a Saturday morning. I would sit down and go through my lists and have to do this, not have a starting point. So I can tell you how much time this saves your
Yeah,
investors.
absolutely. This screen just summarizes what we talked about today, Howard. I believe, and not everybody believes this, but I strongly believe that earnings reports should be avoided because we're doing a low risk conservative strategy covered call writing. It applies also to cash secured puts, similar low risk strategy. Now, the reason why some investors do like earnings is because the premiums are much higher, generally speaking, because of the higher implied volatility leading up to earnings, and then you have the volatility crush afterwards. It just drops down.
Sure.
Now, if you want to own the shares, we talked about this through the earnings report. Perhaps you've owned these shares a long time. You're writing covered calls, portfolio overwriting, and but the earnings report is coming up. Just let it go. Let it ride through the report. Hopefully, you'll get a beat and it'll go way up. But even if you get a miss, you haven't risked the possibility of missing that appreciation,
Right.
and the possibility that in order to retain the shares, now you got to pay the intrinsic value that the stock has gone up to keep those shares. It could cost you a fortune. So don't let the report pass. See what happens. Let the volatility subside a little bit. Now, boom, you go back into the game with covered calls after that.
Yep.
Uh, now, use securities that aren't reporting in that particular cycle. Weekly options that we talked about to circumnavigate reports, and of course, any exchange traded fund that passes our series of screens are good.
A couple of things that I want to just touch on that you said there. One of them was huge. Is that I, in my opinion, is you have a thesis. Your thesis is on how to lower risk but still make a good earnings and outperform sort of the benchmarks with your style versus someone that just buys the S&P. That is exactly what your program does. So right, do not get enticed by those high premiums. It's like the fancy, flashy slot machines next to the door at the casino that they always say have the worst odds. There's a reason they're offering you those high premiums. There's a reason that they're there because, like you said, you might lose half of what your gain could have been there because your shares get taken away, get exercised during this type of thing. And you might have, if you're not in a retirement account or a tax deferred account, you're in a situation there also where you could have a tax implication from it that you weren't counting on. So I love the idea of having a thesis and trading with that thesis. I will say you've brought up about seven other interviews for us to do already that I've written notes here on based upon things that I've seen in these reports or have questions about, or what you've brought up, today about how, using just ETFs or sectors. I want to ask because I am a big fan of sectors when it comes especially to cyclical trades. I think that they are sometimes it's almost like people don't see the in front of themselves is a beaten down market like maybe today where oil got beaten down is the time to look at that sector for some of these sector moves for those that are looking at more of a long term portfolio outlook. A lot of times what we talk about on the show is really the day traders, so this is great information for those people that are looking for their retirement accounts, for their 401ks, and for but it isn't, because the way that you do this with even weekly selling of options, it's bringing revenue in on a weekly basis.
It helped pay for my son's college and then professional school educations. I bought my first real estate investment property with the cash that I generated from selling options. I mean, it made a huge difference in my life. Now, just so you viewers know, I mean, we've talked about this everything sounds great, almost like it's a panacea here, but there is risk. I mean, it's low
Absolutely.
risk, but there's risk, and that's why in the BCI methodology we created all these rules and guidelines to help avoid the risk and minimize the risk. And that's why, if I could use a baseball analogy, I'm not sure if I used it last time, Howard, but you'll probably hear me use it again and again and again. Um, we're never going to hit a grand slam home run with covered call writing, but we're going to hit singles and doubles all day long. And once you do that, you have to learn how to manage a trade.
Yeah. Hey, Wade Boggs
It's not like
Wade Boggs
I'm
made a
stock.
lot of money hitting for average.
Yeah, exactly right. And once you enter the trade, you don't like curl up into the fetal position and hope for the best. You go into management mode, and there's so much you could do to mitigate losses, turn losses into gains, or enhance gains even to higher levels. My eighth book was Exit Strategies for Covered Call Writing and Selling Cash Secured Puts. It's 27 chapters of exit strategy
Wow.
information. Now, it's
Wow.
not rocket science. Everybody can learn it, but if you don't know that those opportunities exist, you're not going to do it. But if it's out there in black and white for you to read and understand, and then I even give guidelines as to how to tell when to buy back the option if an opportunity is coming along. So it's intimidating for beginner investors, because it seems like so much. How am I ever going to learn this? But I use the analogy also. It's like driving a car. You're scared to death the first time you're on a highway, and then after that, you just go.
Right. Absolutely. And that's what it is. I can tell you is again, what's nice is sometimes because I am a fairly new trader. I only got into this in 2013 and on the crypto side, only really got into the stock trading side, in a big way during COVID. Is that yeah, it is intimidating. But what I love about your program and what I've seen is that you guys really do bring so much to the table that takes a lot of that scariness away. Am I going to pick the right stock to start off with before I even start figuring out the covered call part of it? And you've got all of these components sort of built out for people, and it allows for an easy acclimation. And I'd have to guess that your learning curve with your students is a lot quicker than in a lot of different programs out there because of that. The fact that you have this methodology built up over 30 years.
Yeah, yeah, that's true. I mean, it probably took me a few years to get all this figured out because I took all the information that was out there in the mid 90s. I looked at it and then I started over. And I
Yep.
started creating my own rules and guidelines, algorithms, spreadsheets, et cetera, et cetera. And I thought I'd be doing root canals and crowns all my. What did I know? But once this happened and people were interested in what I had to say, then I started sharing everything that I've learned. So to your point, and we've dealt with thousands of beginning options traders over the years from all over the world, not just the United States. 3 to 4 months doing your due diligence, learning the methodology, paper trading for a month or two. So a total of 3 to 4 months. And then you're ready to get started in a conservative way. Don't start with all your money
Right.
right away. Start with a little bit of it, dip your toes in the water, and then you'll have years and decades to benefit from these strategies.
Absolutely. I'm actually writing another note because I'm going to sort of put there is that's one that I know that we did very well at Prosper Trading Academy that I haven't seen a lot of people use, which was allocation of portfolios and telling people, don't follow any signal that we give you or any trade that you should do needs to be weighted in a way that also protects your portfolio. You have to, if you don't preserve your income, you never can grow your income. So making sure that people have the right sort of setup there is one for us to talk about in a future day because I think that's so important. You get so many people that join these courses, they get too excited because they hear testimonials from other people and they start to get excited and they go in and they say, okay, I got $10,000. They put it all into their first trade. And that, we want to make sure people don't do that, that they're following a good methodology for doing that. I'm sure you've run across that over the years.
Oh, when I do my live seminars, one of the biggest problems I have is just what you're talking about, Howard. People get so excited if it's on a Saturday, they want to start on Monday.
Yeah.
They said, I understand everything you said. It was a really good seminar, this, that, and the other thing. I'm going to start trading on Monday. I said, you're not
Yeah.
ready. You're not ready. You
Yeah, they
know,
don't because it is the pressure that comes once you hit that button and you own something. They don't understand that because there's going to be the ups and downs that are going to hit, especially with the option part. Those premiums are going to move pretty quickly on people and they start to get nervous. So that is one thing that I always try to stress with all of our educators and contributors here on Quasar Markets is that everybody is teaching the proper portfolio management, and it's not an all-in-one bucket and all-in-one trade thing that doesn't work. That's how most traders actually burn out and crash, unfortunately. That's always been what I've seen is, the huge amount of percentage of traders that actually do burn out and crash, so to speak, lose everything they start with. And I see most of those are because of over allocation of funds into one trade. And
yeah.
then the other thing we always teach people, there's no such thing as doubling down. You can cost average a stock in the right circumstance, but never use that terminology double down because it gets you into a gambler's philosophy, and that's not what you're doing with your money, we hope.
Yeah, you actually, I know this is way beyond the scope of this particular discussion, but you can actually use call options to lower your break-even price on
Right. Oh yeah,
stock.
absolutely. We went over that a little bit last time. We'll go over that more. Absolutely. We're not saying you're stuck with it. You bought it, you're stuck with it. In fact, you just said you have 27 chapters of how you exit that trade based upon variables that could come with going up and going down and everything that comes along with it. That definitely is the case too, but I just always find that people get so excited that they get too excited and then they get a negative connotation because they don't really know the whole program and they go in with not enough knowledge and then they panic before they ask, enough questions and learn and they get down on a program or down on themselves.
Yeah, yeah. They've gone all these years not using covered calls. Wait another 3 or 4 months. You
Yeah,
know.
exactly. That is the greatest thing. You've hit on one of the big ones. Stephen Flanagan hit me with a good one at the end, so we're going to end on that one. But he told me, Jack be nimble, Jack be quick. Just Jack, don't get stuck on top of that end and candlestick. And I was like, that's a
Very
good
good.
one too for trading. So, Alan, thank you so much for joining us today. Can't wait to see you next Monday, and thank you for your time.
Always my pleasure, Howard. Take care.